Hello and a warm welcome to Econo Day Unplugged on Wednesday, the 3rd of February 2021. Mark Pender is suffering a power outage on the US East Coast. So on this week's podcast, it'll be Brian Jackson in Sydney and myself, Jeremy Hawkins, here in London. Well, hopefully somewhere between the virus infections and the battle between retail day traders and the hedge funds, there's still scope for actual economic fundamentals to have a say in where markets are headed. There's certainly a lot of data scheduled this week, and in today's podcast, we'll round up the main themes around the globe. But before we do that, I think it's probably worth noting that in terms of COVID, it's not so much infection rates as the delivery timetable for the vaccine that's become the key metric for investors trying to assess which economies are going to lead the way towards securing a sustainable recovery. So, Brian, perhaps if we can kick off with you, and you can sort of give a quick update on how the vaccine rollout is shaping up in your part of the world.
Yeah, it's obviously it varies from country to country, but most governments across the region have some sort of plan in place, but it's not going to be a quick process, as is the case elsewhere in the world. So in the meantime, we are still seeing outbreaks in various parts of the Asia Pacific region. Just in the last 24 hours, we've had another case take place in Melbourne, in Australia's second largest city, and concerns that could spread pretty quickly has prompted authorities to introduce some new restrictions. And right across the region, we're seeing similar sort of stories: Hong Kong, parts of northern China, Japan. So it's still very much trying to contain the virus through public health restrictions rather than relying on the cavalry to come in the form of a vaccine for the time being.
The vaccine's been manufactured in Australia and in your part of the world. Obviously, the likes of, well, say India's not exactly just down the road from you, but I think that's the world's biggest vaccine maker. But are you actually manufacturing vaccines in Australia?
Yeah, there will be some of that. I believe down in Melbourne, there's facilities. So hopefully that will spread the rollout, quicken the rollout. But we're obviously down in the southern hemisphere in summer as well. So I think they are hoping that well before we get to our winter, there'll be some pretty good coverage.
Okay, let us hope so. Okay, let's get down to some of the economics then. Australia, RBA, they've just extended their quantitative easing program, and yet from what I gather, it seems that they just sort of revised up their expectations for the economy. So what's going on?
Yeah, I mean, they're obviously a little bit pleasantly surprised by the strength of the recovery over the last few months. So we had the RBA out yesterday delivering a speech saying that we're hoping to get back to sort of pre-pandemic levels of output more quickly than they had previously anticipated. But
so when is that? When are they hoping to actually get GDP back to where it was? Because I mean, for Europe, for example, they're still talking well into next year at the earliest.
No, they are hoping sometime this year that we should get back to that sort of step one, square one. So that's good, I guess. Obviously, it's still very much about the change in growth rather than the absolute level is probably what's most important for people's chances of getting a job and getting back some decent income growth. But that will be a pretty good marker for just how far we have come back from the depths of the initial impact. But in the meantime, growth obviously is good, but the RBA is still also focused on inflation, and there's no sort of indication that we're going to be getting back up into their 2 to 3% target range anytime soon. So for that reason, they don't see any case for removing the policy support that they've got at the moment. And just earlier this week, they came out again very explicitly when they had their policy meeting saying, we do not see it at all being likely that we'll raise rates again until 2024.
Yeah, so low interest rate still for a long time.
Yeah.
Okay, what about China? PMI suggesting some cooling, and I suppose also with China, I should also ask you quickly, have there been any further developments in this sort of spat between China and Australia from a political standpoint?
Yeah, well, just on that second point, it actually, it does seem to have gone off the front pages a little bit in the last, since the last time we spoke. It's still simmering there in the background, and we actually had an interesting development in the last week or so, whereby we had a trade deal between New Zealand and China. Obviously, New Zealand and Australia have always had a very close relationship, and now New Zealand has sort of been, to a certain extent, deepening its relationship with China, and also at the same time suggesting that Australia needs to perhaps change its approach to the way that our government has been responding to some of the things China's been doing. So that in turn creates a little bit of tension between Australia and New Zealand. So, it's still very much a live issue right across the region, how people do respond to some of the pressure that China's been putting on their bilateral relationships, and so that's going to continue, I think, going forward. Now, in terms of the China economic data, yes, we've had the PMIs in the last couple of days, and they've sent a pretty clear message that we've had a bit of a stalling in the momentum of China's recovery in both the manufacturing and the services sector. Now, we don't want to make too much of just sort of 1 month's worth of data, but I think going into the Chinese New Year holidays, which are just about to start, we have definitely seen a bit of an impact, probably from some of the outbreaks of COVID that we've had up in the north of China over the last 5 to 6 weeks. So there've been lockdowns put on pretty large cities in that part of the country, and we've also seen authorities tighten, or at least recommend tightening of travel over the Chinese New Year period. As you know, millions and millions of people travel back to their their hometowns or home villages over the Chinese New Year period, and that provides a huge boost to consumption and travel and other parts of the economy over that period. So if we do have a noticeable and significant drop in that travel over the holiday period, then you're going to see that basically in the numbers over the next month or so.
Okay, fair enough.
And just on that, I mean, we are
Yeah.
also, every year at the start of the year, we do have this sort of blind spot in the Chinese numbers, because
right.
they don't release separate data for January. Normally you'll have for instance, you'll have April data come out in mid-May, or September data come out in mid-October, but that doesn't happen in February, because they combine all the numbers for January and February to try and remove the impact of differences in the timing of the Chinese New Year holidays. So what that basically means is that we're not going to get a good picture of how the Chinese economy is going for another 6 weeks in mid-March, when we'll get combined numbers for January and February.
Okay, interesting. India, we've got an RBI meeting on Friday. We also just had their union budget as well. Was that expansionary enough, do you think, to have any implications for how the RBI might vote on Friday, or is it kind of a done deal anyway?
I think it probably is a done deal. I think, again, RBI, similar to other central banks in the region, have shown that their priority is still supporting economic recovery, and so I don't think there'll be any move to remove some of that policy support for at least the time being. There has been some noise or volatility in the headline inflation numbers in recent months, but that's mainly been driven by swings in food prices. So we tend to find that the RBI tries to look through some of those swings in food prices and not get too hung up on the impact that has on the headline CPI number, instead trying to pay attention to the underlying trend. And so that's been pretty steady. So I think for the time being, they'll again want to keep policy pretty supportive, and not make too much changes later on this week. What we have seen though is that actually the PMI numbers for India that we got this week were pretty good, and so they are actually starting to see some decent growth in the Indian activity numbers. And so, I think obviously RBI will welcome that, but I don't think they're going to be removing policy support at the time being.
Fair enough. I must ask you, certainly there seems to have been a fair bit of media coverage of these protests from the farmers against agricultural reforms. And from what I've seen, it seems to be, a lot of people are talking, many thousands involved in these protests. Is this significant for, GDP, or is it something which is going to blow over, do you think?
To be honest, I missed that. So I'll have to pass on that one. Obviously agriculture is a relatively large part of the Indian economy, so any developments in that sector will have an impact on the broader numbers. But I'm not too sure what's going on that particular issue. But just briefly, I mean, what has been striking about the PMI numbers that we've had since the start of over the last 4 or 5 days is just there has been quite a bit of variability between different countries. You've got so India, as I said, had a pretty strong set of PMI numbers. Also, Singapore and Korea both showed some pretty solid increases in activity. But then on the other side of the ledger, you had Japan, China, and Hong Kong all weakening quite significantly in January. So, a bit of a two-track situation for the Asian economies at the very start of the year.
And has that got anything to do with the vaccine delivery or the infection rates, or just the way
I think there's definitely an element of that. Hong Kong has had a pretty nasty outbreak and some real severe public health restrictions that have been put in place. We mentioned the situation in the north of China recently as well. That's clearly, I think, having an impact. And in Japan, we had a state of emergency in Tokyo and some surrounding areas, having an impact, I think, on activity and sentiment there. You've also, still got these ongoing concerns about whether the Tokyo Olympics are going to be able to go ahead.
Yeah, I was going to ask you about that. Yeah.
So far the authorities are insisting that it's all systems go and still planning it, but and even just this week, we've had people come out saying, yep, it's going to happen no matter what happens with COVID. We're going ahead with this. But clearly, if the situation was to worsen really significantly, there'll be just more and more questions about that. So we can only hope that over the next 3 or 4 months, the vaccine and other measures do allow them to go ahead with that.
Okay, you touched on it briefly, but just let our clients our clients know rather that we will be adding South Korea to our country coverage, and Brian will be the guy doing it. So just in a nutshell, anything you particularly want to say about South Korea at this stage, what we should be looking at or thinking about in terms of where the country is moving at the moment?
Well, I think one of the reasons why we are always interested in what happens in South Korea is that it's one of those Asian countries that are very much exposed to global trade patterns. And so it can often give you a good leading indicator of what's happening more broadly in demand and production across that global supply chain that Korea is very much a part of. Mm-hmm. It's also useful in that they tend to be one of the first countries to actually report the trade numbers each month. So, it's always a good idea to keep an eye on Korean trade numbers, just to get a feel for how global demand is developing.
Excellent. Okay. Anything else you'd like to add from your part of the world?
No. Obviously, there's been a lot of focus about some of the swings in the US markets over the last week or so, but not having a huge impact, I think, on the policy outlook across the region. I think it's very much a case of just maintaining the current high levels of policy support and no great urgency to start withdrawing that.
Okay, excellent. Thanks for that.
Yep.
Right, moving on then, as they say. Well, I guess in the absence of Mark, just mention that US-wise, I guess it's fair to say that there haven't been too many surprises in terms of economic numbers anyway. We're still waiting to see what the final stimulus package will look like. But 4% fourth quarter economic growth in the States was pretty well in line with the market consensus. Even so, the FOMC last week signaled that it has no intention of withdrawing support from the US economy, reiterating that it will keep its quantitative easing program at $120 billion a month until substantial further progress has been made in the recovery, which of course keeps it nice and bland, so gives them effectively an open book to do what they want. As far as this week's concerned, we'll get the new payroll on Friday, expected to be up about 50,000 after a decline of 140,000 in December. But I guess after a large increase in the ADP measure earlier on today, there may perhaps be a little bit of upside risk to the current consensus. Dollar-wise, it's worth mentioning, and again, I think this partly goes back to this COVID side. The US is running about number 5 in the vaccination rate globally at the moment, and the relatively quick delivery there certainly seems to be helping the greenback to make ground against, especially the likes of a euro. It's up almost 2.5% against the euro now over the course of the last several weeks, and it really does seem as if these vaccination numbers are becoming more and more important to investors. So my part of the world then, for Europe, well, it's, as far as COVID's concerned, the European Commission now is asking for more coordinated action amongst the member states to limit travel from high-risk areas. Really, it's been extremely unhappy with the cuts in deliveries of the vaccine from AstraZeneca and Pfizer. And that, of course, led to a major bust-up last week when the European Commission decided to suspend part of the Brexit deal agreement on Northern Ireland in a bid to impose restrictions on COVID vaccines, or at least components of vaccines exported from the bloc via Ireland to the United Kingdom. I mean, Ireland wasn't even consulted in this decision, or even informed for that matter. So it went down like a red balloon, and the actual proposal itself was pulled out very quickly. But it really underlines the fact that the vaccine rollout, as far as continental Europe's been concerned, has been extremely slow. Indeed, it's becoming a major political issue for the likes of German Chancellor Angela Merkel, and we have German elections in September. So they really will want to start getting further progress on this rollout as quickly as possible.
Are there any parts of Europe that are doing a better job than some of these areas where there's concerns?
Well, before I get onto the UK and wave the little the Union Jack flag over here, the only part of Europe, to be honest, which is performing well on this front is the UK, which managed to get hold a lot of vaccines very early on. And that's really allowed it. And of course, it does has the Oxford AstraZeneca base in the UK anyway. So it's meant that for the UK vaccination rate at the moment stands just behind, I think it's Israel at the top and the UAE in number 2 place. So the UK is running third. And to put that in perspective, it's the current rate for the UK vaccination is just over 4 times what we're seeing amongst the bigger European countries like Germany, France, Italy, and Spain. I really do think it's one reason why investors looking at Europe at the moment, they're seeing increasing COVID restrictions being introduced. Germany's extended its lockdown program now through until at least March. And there's talk it may be extended as late as Easter. In France, we've seen the curfew times being extended as well. So almost wherever you look, we're seeing sort of bad news in terms of the additional lockdown or containment measures being introduced, which will inevitably hit first quarter GDP. And yet we're not seeing the kind of offsetting good news in terms of quick vaccine delivery, such as we're seeing the likes of the UK. So, for example, looking at where sterling is at the moment, I mean, sterling's had an extremely good time. It's up about a couple of percentage points or so against the euro since over the last month. And that really does seem, as much as anything else, to reflect the fact that the vaccine rollout is coming out so much more quickly. Investors are hoping for a faster turnaround in the economy, because by and large, the UK economic data have very much reflected the latest lockdown. So although we don't have fourth quarter UK GDP yet, it's almost certainly to be a lot worse than the Eurozone. That showed a 0.7% quarter-on-quarter decline. The UK, I suspect, will be significantly steeper than that. But as I mentioned, the pound is still going up. So yeah, Europe then, as mentioned, say fourth quarter GDP, the Eurozone down 0.7%. And it's got to be said from the way these restrictions are still in place that we're probably going to get a first quarter contraction as well. So if that's the case, that's going to put the Eurozone back into, its second double dip recession, which can't be good news. And to be honest, that's probably true for the likes of the UK as well. And what we are seeing, I think, because of the slowness of the vaccine rollout, it's really starting to hit consumer sentiment. So we've seen household morale sort of down pretty well right across the Eurozone. It's also fallen in the UK as well. I think that's more to do with the numbers being so weak. And it's a notable worry in Germany. I mean, in December, we saw retail sales volumes in Germany down 9.6% on the month. And to put that into context, that's more than 3 percentage points more than we saw during the worst of the first coronavirus wave. So at the moment, the European economy really isn't shaping up too well, which means that today's inflation report out of the Eurozone came as a complete surprise. So as we've been talking about for such a long time now on the podcast, Eurozone inflation has been, to all intents and purposes, non-existent. As of December, the annual rate was running at minus 0.3. It's been down there for several months. Today, we saw it bounce up to 0.9%. So that's what, a 1.2 percentage point increase in inflation in just 1 month. And the core rate, we know that oil prices are backed up, but the core rate was up at 1.4% from 0.2%. So that's up 1.2 percentage points as well. Now, yes, we've just had a reversal of the cut in Germany's VAT. They cut that rate by 3 percentage points in the middle of last year. So that went back up again in January. But that was nothing like enough to explain what's going on. So it's going to be interesting, I think, looking at the upcoming inflation numbers out of the Eurozone, because there's clearly still speculation that the ECB may have to do more in terms of easing its policy because the economy is doing so poorly at the moment. But there's obviously also a number of hawks amongst the governing council who are A, uncomfortable with the amount of quantitative easing that's already been undertaken, and B, are being concerned that it would lead to higher inflation at some point. So these inflation numbers, I think, are going to cause something of a punch up at the ECB come the next couple of meetings or so.
And
so
I think those inflation numbers have also, surprised the upside, but that's had a bit of an impact on our divergent index, hasn't it?
It has, very much so. I think that's right. I mean, we put together some indices at Econoday, which looks at how economies are performing versus market expectations. And we got to the stage now whereby we've had inflation numbers. And I mentioned the CPI, or the HICP, as Europe likes to call it, the inflation number there. We also have producer price index out as well, which is a little bit stronger than expected. And the signs are really that inflation, the kind of numbers we're seeing at the moment, would suggest that the Eurozone economy is doing very well. In practice, I suspect the upside surprise has more to do with some of the problems being caused by COVID, notably with regard to disruptions to supply chains. Also, of course, we're living now in this early post-Brexit world, or such as now we're in the Brexit world. We're post the transition stage, under which a lot of port activity has been disrupted, with companies having to fill in new forms to export or import between the UK and the European Union. And it's certainly been reflected in a massive increase in delivery times and putting upside pressure on prices. Now, that may be just a short-lived thing. We'll have to wait and see. But it has led to, I think, generally speaking, there's been all this talk about, is inflation about to go up? Well, for people who think that's the case, then January Eurozone numbers are certainly going to stir the pot a little bit.
And what about the European PMI numbers then? I guess they've been pretty mixed this week.
They have, again, and the trouble with them, most of the PMIs over here, you say in your part of the world, you've got some relatively strong ones. By and large, as far as Europe's concerned, they're still looking pretty miserable. So if we look at the updated, the final figure for January for the composite output index for the Eurozone as a whole, that was at 47.8. So it's down from 49.1 in January, and ultimately suggests that as far as January is concerned, the Eurozone GDP contracted. If you look across the various countries, the only member state which actually registered a positive number was Germany, and that was only at, where are we, 50.8 if I remember. So it does look as if these various lockdowns are having quite a significant dampening effect upon Eurozone growth, and
Right.
most of these restrictions are going to remain in place for a while yet.
Okay.
What else should I be mentioning? Super Mario. Bran, you remember Mario Draghi?
I do, yes.
Yes, indeed. The former president of the European Central Bank before Christine Lagarde took over. Well, he may be the next Prime Minister of Italy. This, of course, is the man credited with saving the euro with his whatever it takes speech during the exchange rate crisis back in 2012.
I always think former central bankers are just bound to be successful politicians.
Well, I mean, you do wonder. We're talking Italy here, so I must say, who knows? But I suppose at least, I mean, apparently he's accepted the request from the Italian president to try to create a new technocrat government. Whether he can do it or not remains to be seen. I mean, he's going to need to get majorities in both houses of the Italian parliament, and that won't be easy. But markets, I must say, rallied quite significantly on the back of this. The Italian bond market's well up. The Italian stock market closed well up today as well. And that's, of course, on the grounds that, well, they know that Mr. Draghi has proved himself to be a major dove when he was at the ECB. And, of course, he's also very much pro a united Europe. But his problem will be that if you look at the opinion polls currently, the leading party is the Lega Party, which used to be called the Northern League, and that's a right-wing anti-establishment party, which is currently running at 23%. And not far behind them is the far-right Brothers of Italy, so-called, with about 16%. So if he gets the job, I think it will be good news as far as Italian markets and indeed the euro is concerned as well. But it's certainly not clear that he's actually going to do that.
Right.
Okay, what else I've got left? I'm going to mention the Bank of England, which could be quite interesting this week. There's been speculation we talked about on various podcasts about the possibility of the Bank of England introducing a negative bank rate, which would be the first time in its history. And the fact we'll be also getting a new monetary policy report, which contains the bank's updated economic forecast on Thursday as well, sort of potentially provides the the fundamental background for some kind of a cut. But listening to all the comments coming out of the various MPC members, it really doesn't seem that it's going to be a clear-cut vote. There's certainly some people who do favour going negative. Others are certainly still against it. A lot of people, I think, really don't know. So at this stage, it looks as if probably bank rate will stay at 0.1%. Quantitative easing still looks likely to be held at 895 billion sterling. But
is there anyone on the MPC who is likely who's expressed some sort of a difference of opinion from the majority?
Well, Silva Tenrero, who's one of the external members, I mean, she has been proposing negative interest rates for some time. She believes if you look across the water to the Eurozone, she thinks that negative interest rates there have provided a boost to Eurozone growth. I think, but I mean, to be honest, it's hard to unravel some of the effects of whether interest rates have been good or bad. It may be it's provided some support for Eurozone economic activity, although when you look at the growth rates over there, they're hardly spectacular. But I think as concerns, I think, in the UK, a bit like we've seen in Switzerland, although, of course, there we do have negative interest rates already, that negative rates ultimately will do more damage than good because they're going to undermine banks' profitability. And in worst case, because banks will be hit on their profit side, the institutions will start getting more involved in, let's say, less prudential lending practices, which could actually be damaging to financial markets, full stop. So it's going to be an interesting one tomorrow. It's certainly be interesting to see what the bank has to say. Personally speaking, I think the odds are probably against another cut, but it is a possibility and one that certainly investors will be looking at. I mentioned, say, UK vaccine rollout doing very well and offsetting disappointing data. But to round off my side, one country where the data has actually been holding up pretty well is Canada. In line with the US, I guess, the numbers there continue to be pretty decent. November GDP, they have monthly numbers up 0.4% on the month, and they have a flash estimate for December of 0.3. Lump that lot together, and it would suggest that fourth quarter GDP would be up 1.9% quarter on quarter, or in US terms, an annualized rate, that would be almost 8%, which would be a pretty impressive performance, and certainly a good deal stronger than the Bank of Canada itself was expecting only a week or so ago. So that's prompting additional speculation that we could see Bank of Canada being amongst the first of the major banks to actually start tapering its quantitative easing program. Okay, that I think is it from my side. So, Brian, you done?
I am, yes. I guess in Mark's absence, we could have a long, extended discussion about cricket, but we might take that offline.
Strangely enough, I can hear all our listeners tuning out at that very moment.
Sure.
Yes, okay. Quite right too, though. Okay, well, let's wrap it up there then. So on behalf of Brian and myself, thanks as ever for listening. We're back next week. And in the meantime, of course, you can keep up to date with all the key market moving data and events in Econoday's global economic calendar. Bye for now.